All right, let's go ahead and get started. Hope you can find your seat. All right, please put away your notes and everything except the device you're using for the quiz. All right, here we go. Question number 1. What is the purpose of a cash flow statement? Is it to show income and expenses? Is it to summarize cash receipts and payments during a period? Is it to describe assets and liabilities on the books? Or is it to illustrate what is included in equity? What is the purpose of the statement of cash flows? All right, you remember the picture of the bucket? And we said the cash flow statement tells us why the water level changed, right? So the beginning balance in cash, ending balance in cash, why did it change? So we're summarizing the cash inflows and cash outflows that take place during the period. So that's the point of the statement of cash flows, and we'll spend the whole day talking about it today. Question 2, which of the following is an example of a cash inflow? Which one would generate cash coming in? Issuing stock, paying dividends, purchasing treasury stock, or repaying principal on a loan? Which one would be a cash inflow, cash coming in? Okay, you should not be talking to your neighbors about this. I'll give you a hint. Look at the verbs, right? So pay, cash outflow. Repay, cash outflow. Purchase, cash outflow. So the only one that's a cash inflow is when you issue shares of stock, then your investors invest cash in the business. Question number 3. The indirect method starts with which amount and then makes adjustments. So what's the starting point for the indirect method? Is it accounts receivable, sales revenue, net income, or depreciation expense? So we have the direct method and the indirect method for calculating the operating section. If we're doing the indirect method, what do we start with? All right, the indirect method starts with net income, makes a bunch of adjustments, and gets back to operating cash flow. We'll spend quite a bit of time practicing that again today. Question 4, which of the following is not true of our rule of thumb for cash flow adjustments? Increases in assets result in negative adjustments. Increases in liabilities result in positive adjustments. Or increases in equity result in negative adjustments. Which one of these is not part of the rule of thumb? I sort of forgot this question was on the quiz when I wrote on the board this morning. I actually put it up here, right? So when you have an increase in an asset, that would be a negative adjustment, and when you have an increase in a liability, that's a positive adjustment. So the only one that was made up here was the third one, the one about equity. All right, last question. Question 5, which of the following is a financing activity? And we have operating, investing, and financing. So purchasing equipment, paying wages, paying cash dividends, or the sale of a building. Which one of these would be a financing activity? Okay, so the answer is paying cash dividends. Let's quickly review. We're going to practice this a lot today. Which types of balance sheet accounts are associated with operating activities? Operating, so current assets and current liabilities, right? Which type of balance sheet accounts are associated with investing activities? Long-term assets, right? So property, plant, and equipment, things like that. And which type of accounts on the balance sheet are generally associated with financing activities? long-term liabilities, and equity accounts, right? So we'll practice that some more as we go throughout the day. All right, before we get started, I want to start with my last slide first. All right, so lots of big things happening. The first midterm is a week from last night. So Monday night next week is when we'll take our first midterm. And the midterm will be here in this room, and it starts at 7 o'clock. So I've got some important guidelines. Well, actually, let me say this first. Thursday, please come to class if you can. It's a review day. We're going to review everything. I'm going to try to prepare you for the exam. I would encourage you between now and Thursday to go through the practice exam if you haven't done so already. So if you go to NBC, scroll all the way down to the bottom on the main page, you'll find the practice exam for exam number 1. I kind of warned you a week ago that the multiple choice questions will be covering like the first 4 chapters that we covered. And then the workout problem, which is 40% of your grade, will be the statement of cash flows. So I need you to at least work through it once. The first time through, it's going to be very difficult. A lot of students have to work through that practice exam 3 and 4 times until they start to feel completely comfortable with the material. So please make at least one pass through it between now and Thursday, and we will go over the exam in class. In particular, we're going to spend time reviewing the statement of cash flows. There's a huge statement of cash flow problem on that exam. So logistics for the exam Monday night. Exam starts at 7 o'clock sharp. And so the hard part is we got to get everybody in here seated and ready to go before then. So I encourage you to please arrive between 6:30 and 6:40. Notice we've got 2 doors to this room. Everybody tends to come in this one over here. You can come in this side as well because it's going to be a big traffic jam on this side. So I encourage you to come in both doors. When you come in, you have to have your student ID so that we can check you in. I'll have some TAs here helping me. Okay, so have your student ID, and at the very latest, I need you seated by 10 till. So again, try to be here in time to make sure you can sit down. When you walk in, it's going to be somewhat like when you come to a normal class, because you're going to be randomized into a different location for the exam. And so come in, find out where you sit. You'll have the map just like we typically have on a regular day. That's where you're going to sit. We will give you a Scantron. While you're sitting here waiting, please fill out the Scantron. And then we'll have to hand out the exams right before 7 o'clock. So I'll talk more about this at the exam review. I just want to make sure everybody knows this. Obviously, closed book, closed notes. You're allowed to bring a calculator and a pencil or something to write with, and that's pretty much it. We won't have class next Tuesday, obviously, to make up for the fact that we're doing the exam that evening. Okay? Any big picture questions about that? All right. So I want to thank you all for showing up today. I sent you that email over the weekend because I really wanted to make sure you did your best to attempt the homework. I realized this was probably a really hard homework to attempt on your own. I'm kind of toying with the idea. I know I was in the accounting lab yesterday and saw some frustrated faces of people trying to figure this out. We may give you you had 2 attempts on the homework. I've been talking to my TA. We may give you a 3rd attempt if you want to try one more time on those problems. You have to know the statement of cash flows. And so after today's class, I'm hoping it's going to be super clear. So today, if you turn your handout over, our agenda for the day is to actually work a full statement of cash flows. Actually, let me say one more thing before we get started. On the very first day of class, I said this. In the past, this class used to have people take it and drop it a lot. We had a pretty high drop rate. And so one of the things that we've done in this class is we try to give people hope to keep on working till the end. And so I just want to say again what I said the first day of class. I'm hoping you're going to work really hard all throughout this next week and prepare yourself. Take the practice midterm 3 or 4 times. Make sure you know how to do it and do extremely well. Some people get caught off guard by the first midterm, and so they just kind of want to give up. The thing I want to emphasize again, like I said the first day of class, if you don't do well in this first midterm, it's okay. Keep on coming to class because people tend to do better on the second midterm and the third midterm. The final exam at the end of the class is optional. So if you've had a bad midterm somewhere along the way, you take this final, it's comprehensive, but by the end of the class, you get all this stuff, right? So for example, statement of cash flows is pretty hard right now. By the time you get to the end of the semester, it's super easy. And so people tend to do super well. They do much better on the final than they did on one of their previous midterms. The score on your final replaces your midterm score. So let's say you got a 40 on the first midterm. But you hang in here. You get a 70 on the next midterm, an 80 on the next midterm, and then you study really hard for the final and get an 80 on the final. Well, that 80 will replace your 40 on the first midterm. So keep coming to class, right? Like right here today, you're all here. It kind of makes me sad because we get to the middle of class and I start seeing all these open seats, people not showing up. I know it's hard to get up for an 8 o'clock class. That's why I motivate you with a quiz at the beginning of class every day. Keep coming to class and hang in there because, as I said, 80% of the people that took the final actually did better than they did on some previous midterm. And 75% of people actually moved up a half a letter grade or more in the class. So it's definitely worth hanging in here. All right, so the plan for today, we're going to practice a full statement of cash flow. So the handout for today is a full-blown cash flow problem, similar to what you'll see on the exam. So when you, on the class examples we did last time were kind of like separate standalone, an operating section, an investing section, and a financing section. Today we're going to work the full statement of cash flows. When you do the practice midterm, very similar problem. You're going to work the full statement of cash flows. And I'm going to post a problem later this week. Again, another practice problem where you can work the full statement of cash flows. So hopefully with all of these, you'll do pretty well. We're also going to look at the homework. And so going through the homework again with the insights you learned from today's class, hopefully you'll be able to actually feel confident and comfortable doing those problems. All right, let's go ahead and get started. So here, guys, today, like more important than any other day this semester, you got to work together and help each other. I saw a lot of you in the accounting lab, and that's fantastic. But when you work together, you can teach one another things that maybe you get that someone else doesn't get, and you can learn from one another. All right, so if I were working this problem, I'm going to show you exactly how I would work the problem if I were taking the exam or if I were doing this problem. So I encourage you to kind of follow along with me, just kind of try my method today and see if it doesn't actually go better for you than maybe what you read in the book. All right, so if I had this problem in front of me, you notice you got two columns. It's 2 years of balance sheet data. And then in the middle of the page, you've got an income statement. So the first thing I would do over here on the right-hand side of the page, I would add 3 column headings. First one, changes. Second one, section. What section of this cash flow statement is it? And the third one, what's the direction of the adjustment? So in this white space over here to the right of your page, that's where I would add those 3 columns. That's where I do all my work before I actually start filling out and preparing the statement of cash flows. All right, so that's the first thing I would do for any cash flow problem. Now, I want to just pause before I get into all the details here. And let's just take a look at the page, what we have here. So obviously we have the 2 years of balance sheet data, 2015 and 2016. If you look at the income statement, so we have sales. We also had a gain. So we sold some property, plant, and equipment, and we had a gain of 100. We have cost of goods sold, general expenses, interest expense, depreciation expense, and income tax expense. And then net income of 1,070. Now, that next little section down there where it says additional information, this is kind of the crux sometimes of the problem. If people blow this part off, then they're going to miss some really important details to be able to solve the problem. So let's read through those. First of all, it says cash dividends paid during the year was 448. That's going to be useful later when we do the financing section. It says property, plant, and equipment with a book value. Now, what does that mean? Book value. It's what you paid for it minus how much you've depreciated it, right? So how much is it worth on your books at this point in time? So it has a current book value of 300, and we sold it during the year. It says all accounts payable relate to inventory purchases, and it says all purchases of property, plant, and equipment were cash transactions. Now, they're sort of hinting that we actually bought some property, plant, and equipment during the year, right? So this information, and we'll see it again on Thursday when we practice the problem on the practice exam, this information is usually critical to solving the problem. All right, and then at the bottom of the page, I gave you that little 3-column matrix for doing the operating section. Again, this is one of the most handy-dandy tools I've ever used for being able to prepare a statement of cash flows. All right, so now we're ready to start working through the problem. All right, this first slide is kind of my summary of how the steps I would go through to do the full statement of cash flow. So I'm just going to walk through it really slowly, and then we're going to practice this as a class. right, so first thing I do when I get the statement of cash flows is off to the right of the balance sheet, I list those 3 columns. So we've got the column headings ready to go. We're going to calculate changes. So the first column, right, is changes. So we're going to go, don't do it yet. I'm going to have you do it with your groups. We're going to go through and calculate the change in each account. So take the 2016 number minus the 2015 number. Just for practice, look at the cash number. So cash had a beginning balance of 110, right, at the beginning of the year. And at the end of the year, it had a balance of 260. So did cash go up or down? Did the water level in the bucket go up or down? So it went up by how much? 150. Guys, there's the answer to the problem. Cash went up by 150, right? The water level in the bucket went up. That's the answer. When you get to the end, you'll know if you got the problem exactly right because that's the answer. Okay? All right, so what do we do next? We're going to go through, after we've calculated the changes in that first column in each account, then you're going to go through and you're going to classify each account as an operating, investing, or financing activity. So again, let's review. We did it for the quiz. Which types of balance sheet accounts are associated with operating activities? Current assets, current liabilities. You're going to go through and put an O next to each one of those for operating, right? And then I is investing activities. What kind of accounts are those again? Long-term asset accounts. So you're going to put an I next to those. And then F stands for financing. What type of accounts are financing activities? Long-term liabilities and equity accounts, right? Okay, so we're going to do all that. Then we're going to actually fill out the operating section. The way we do this, we're going to use that rule of thumb. It's up on the board here to determine which direction the adjustments go in the operating section. Okay, so here's the rule of thumb again. When you increase an asset, it's going to be associated with a decrease in cash, so it's a negative adjustment. When you increase a liability, it would be associated with an increase in cash, so we're going to have a positive adjustment. All right, so you're going to go through, so that's your third column. You're going to determine the direction of the adjustments for all of the O items. And then we're just going to basically go down the income statement and determine whether one or more balance sheet account is tied to each income statement account and which current asset and liability accounts absorb the timing differences between cash flows and income. All right, so that's the operating section. Then we'll go to the investing section. We're simply going to draw out some T accounts for our long-term assets, and we'll be able to figure out cash inflows and cash outflows by looking at those T accounts. Then we'll go to the financing section. We'll draw out some T accounts for the long-term liabilities and equity accounts and analyze any changes in those accounts to figure out if we had cash coming in or cash going out. Okay, so those last two sections, pretty much we're just going to use T accounts. All right, so, and then obviously pay attention to the additional information that we just read right here in the middle of your sheet. All right? So that's the process we're going to follow. So in just a second here, I'm going to turn you loose with your group members, and we're going to start with the first column. All right. So what I'd like you to do first is introduce yourself to your group members. Take 2 minutes, and we're going to go one step at a time, so don't get too far ahead. So introduce yourself to your group members and go through this first column, change, calculate the change in each account, and stop right there. Ready? Go. Guys, let me remind you, you're going to take the 2016 column minus the 2015 column, right? If it's positive, it means the account went up. If you get a negative number, it means the account went down, so we'll put it in brackets to indicate it's a decrease. Okay? Go. So if you finish, check your group members and make sure everybody's on the same page, right? We want to make sure we all agree on how to do this. All right, I think most of us are probably done. So if you're not quite done, just finish up as we walk through this. So if you take the 2016 number minus the 2015 number in each case, you'll get the change. And of course, as I mentioned, the answer to the whole problem is right here. So isn't it nice to start a big problem and have an answer key? So we all know what the answer is going to be when we get to the end. The change in cash is an increase of 150. All right, step 2 is really simple, guys. So the second column here, we want to know what section these go in. So you're going to basically go through each of those accounts and ask yourself, is it an O for operating, I for investing, or F for financing activity? So take just a minute and go through that second column.
I remember retained earnings would be operating or financing.
So you can put O/F because the net income part that goes in is operating. The dividends you pay are financing. So that's the weird one.
Okay.
Yeah.
Yeah.
So when I've been doing these at home, I haven't been using the T-charts because they confuse me too much. Is that like fine for the test, or?
I mean, not everybody learns the same way. I'm hoping that as we practice a little more, you'll start to kind of visualize things in terms of T accounts. So I would say keep trying, because over time I'll be using examples a lot in class where we actually use T accounts. So I would encourage you to, you don't have to, but encourage you to think about it. All right, guys. I think some people went through this pretty quickly because they remembered the rule. Other people are still getting a little bit confused. So just quickly, if it's a current asset or a current liability, that's going to be O for operating, right? If it's a long-term asset, that's going to be I for investing. And if it's a long-term liability or an equity account, it's going to be F for financing, okay? So this is what I would have listed for each one. Now, I'm leaving cash out because that's what we're trying to explain is cash. But in the current asset section, we have accounts receivable, inventory, prepaid expenses, and income tax refund receivable. Those are all O's. Those are all current assets. If you go down here to current liabilities, we only have one in this account, in this particular problem, and it's accounts payable. So long-term assets, we have property, plant, and equipment, so that's an I, and the accumulated depreciation that goes with it is also an I. We'll review that in just a few minutes. And then down here in the financing section, we have long-term debt, common stock, and retained earnings. Now, a couple of groups picked up on something I said last time, and they're actually right. So I listed retained earnings as F for financing, because it's an equity account, right? But I already told you there's a little bit of it's kind of a hybrid, because what? We start with our beginning balance and retained earnings, plus net income, which is operating, minus dividends, which is financing. So the retained earnings account is kind of a hybrid between what's investing and what's operating, right? I'm sorry, what's financing and what's operating. So this could be O/F if you wanted to. All right, so that brings us to the third column, and this is where we have to decide for the O's. Just for the operating items, is the adjustment going to be positive or negative? So if you remember the rule of thumb that we talked about, it's on the board, but you can't see it too well from this side of the room. But basically, if you increase an asset, that would be a decrease in cash, so it's a negative adjustment. If you increase a liability, it would be an increase in cash, so it's a positive adjustment. So with assets, the adjustments go the opposite direction, right? And with liabilities, the adjustments go the same direction that the account is going. So guys, go through all of the O's and just use this rule of thumb to determine if it's a plus, positive adjustment, or negative adjustment. Talk through this with your groups to make sure everybody gets it. Just for the O's, right? Just the O's.
So your assets going down. Your assets going down, so your cash would go actually. Yeah, add your cash ratio.
Yeah, question with the rule of thumb. So if you're increasing liability, cash increases because people will owe you more money.
So yeah, like let's say you go to the bank and borrow money. So your liability went up, but then cash would go up. If you're paying the bank back, cash went down, so liability went down, and cash went down. So they're kind of going the same direction.
Okay, thank you.
Yep. All right, guys, so let's see what you got. Based on this rule down here, if you go through all of these assets up here, if the asset went up, which is true of inventory, accounts receivable, inventory, and prepaid expenses, right? Those assets went up, so the adjustment's going to be negative. In the case of income tax refund receivable, it went down, and so the adjustment would be up, positive, right? And then down here, accounts payable is a liability, and it went up or down? It went down, so cash would go down to be a negative adjustment. So this is how I would code those adjustments. So the first three are negative, then we have one positive, and then the last one down here is also a negative adjustment.
Wait, why is that one not positive?
Which one? Okay, so accounts payable went down. So if a liability goes up, then it's a positive adjustment. If a liability goes down, then the adjustment is negative, right? So they're going the same direction, okay? All right, so guys, these would be the first three steps I would do before I start any statement of cash flow problem. Once I have this, I have most of the information I need to actually fill out the operating section. There's one more step I'd like you to think about. In the middle of your page, so you got balance sheet information at the top, right? 2 years of balance sheets. Then you got the income statement. The income statement and the balance sheet are tied together. We talked about accruals and deferrals when we did adjusting entries, right? So for example, if we pay cash in advance for prepaid rent, we record it as an asset. We're going to record prepaid rent as an asset, right? And then over time, it's going to get used up. So the timing of the cash and the income statement effects are going to sometimes be off by, by some period of time. And so these current assets and current liability accounts sort of absorb those timing differences through accruals and deferrals. So what I'd like you to do is talk in your groups for just a minute. For example, look at your income statement. Sales. We sell stuff to people, right? And sometimes we sell it to them and they pay cash on the spot. And other times we sell it to them and they say, we'll pay you later, so we record it as accounts receivable. So which balance sheet account would be associated with sales? Accounts receivable. So I would actually write, okay, in parentheses here, sales goes with accounts receivable. What I'd like you to do is go through each of these O items right here that have an O by them and try to figure out which balance sheet account or accounts, sometimes it's two, which balance sheet accounts are associated with which income statement accounts. Does that make sense? So go through here and list, anytime it has an O, list which income statement account goes with that. You got it? Take just a minute and do it in your groups. All right, let's talk through this one together. Before I start, sometimes I have to animate these slides in advance, and I'm not exactly sure how the discussion is going to go in class. I want to make two important points before we actually go through that task with you. First thing I want you to notice about this column right here where we calculated the changes in all of those accounts, if you look at this, so example, accounts receivable, did it go up or down? Went up. Inventory, did it go up or down? Up. Let's pick one down here. Accounts payable, what did it do? Went down, right? So this column helps us to describe in words, because on our statement of cash flows, we have to describe what happened. We have to call it the increase in accounts receivable or the increase in inventory. So this is going to give you the words that you're going to write. Did the account go up or down? When you describe what happened, you say, is it a plus? It went up. Is it a negative? It went down, right? So that column is going to help you describe in words what's happening to each account. This column over here on the right, this tells you the direction you're going to make that adjustment. Now, this is really critical. I tried to say this in class last time, but this is where some people get into some confusion. So we have to know the sign of the account. Did it go up or down? So we can say in words, accounts receivable went up, right? But we're just going to take the absolute value of whatever number's here, and we're going to either add it or subtract it. So this last column says, do I add or subtract the absolute value of whatever change took place in that account? So this is kind of the rule that's going to help you take, these are the words we're going to describe, and this is the direction we're going to make an adjustment with those numbers right there. Does that make sense? All right, this is critical. Once you have that down, this is a piece of cake. Now let's quickly go through, and you tell me which income statement account the O's go with. So accounts receivable goes with which balance, which income statement account? Sales. Very good. All right. Inventory goes with which account? Yeah, we have to buy the inventory to sell it, and so it's going to end up in cost of goods sold. Very good. Now, there's one other account that goes with cost of goods sold. Which one is it? Accounts payable. It mentioned in the extra information here that all purchases of inventory were on account, so it's going to be in accounts payable. So accounts payable is also associated with that inventory, which is going to become part of cost of goods sold. All right. Prepaid general expenses. Now scan down your income statement. Is there any expense on your income statement that might go with this? General expenses, right? So if you pay those expenses in advance, we're going to record it as an asset, prepaid general expenses. But then as we use that up, then it's going to be called general expense, right? General expenses. All right, the next one we have, income tax refund receivable. So we paid taxes last year. We get to the end of the year. We calculate our taxes and say, hey, we got a refund coming back. Government owes us money, right? So it's an asset. It's a receivable. They have to pay us money. And so that's an asset account, right? Which income statement line item goes with income tax refund receivable? Income tax expense, right? That's what it's tied with. And I think that's everything, right? That's all the O's. All right, so once we've done that, we're ready to kind of jump into our 3-column matrix. Guys, there are a lot of ways of doing the statement of cash flows. This is the coolest tool, as I've mentioned, that I've ever seen for doing the statement of cash flows. There are some teachers who only teach the indirect method. There are some teachers who only teach the direct method. Honestly, they're just two sides of the same coin, right? Either way, you're calculating operating cash flow. And it doesn't matter if you use the indirect method or the direct method, you're going to get the same answer. And that's what's cool about this little matrix. It's going to help you to see that. So at the bottom of your page, I gave you sort of a blank. Actually, I gave you 4 columns, right? But on the left, you're simply going to list out the income statement. And I would just usually list it in the exact same order that it was given to you. So if you look at the middle of the page, you can just sort of copy down each income statement account and the amounts, and you should get, obviously, if you add them all up, you'll get net income. All right, so that's the starting point. While you're writing that out, I just want to, again, emphasize the importance of understanding the connection between those current asset, current liability accounts and the income statement accounts. So let me just be kind of clear. Well, first question I'm going to ask you. As you scan through the income statement, are there any items on here that didn't involve any cash, any non-cash items? Depreciation expense, right? So I'm just going to give you a quick example up here, and I'll come back to this in a few minutes. So let's assume that a company bought some equipment for $10,000, right? So they bought the equipment for $10,000. The original journal entry when they bought it would be increase equipment with a debit, decrease cash with a credit, right? That's the original entry way back when they purchased the equipment. Well, over time, what's going to happen to that equipment? If we keep running the machines over and over again all day, every day, what's going to happen? Yeah, they're going to use up, right? They're going to depreciate in value, and we also want to allocate the cost of that equipment over time. So each year, we're going to estimate a depreciation expense. And so now, this is different. Like, when, for example, when supplies are used up, we just decrease the supplies account itself. When we're talking about long-term assets, we're going to record the original cost and leave it there forever. So you notice our equipment account says $10,000. That's what we paid for it when we purchased it. Every year, as it depreciates, we set up this temporary, well, it's not temporary, we call it a contra account, and we record the depreciation that accumulates over time here in the accumulated depreciation account. So the journal entry to record depreciation expense is going to be an increase to depreciation expense, debit, $3,000. And instead of decreasing the asset itself, we're going to put the credit over here in what's called accumulated depreciation, right? So this journal entry right here, is there any cash involved in this journal entry? No, it only affects depreciation expense and accumulated depreciation, right? So that depreciation expense right there on the income statement had no cash involved in it today. There was no cash that took place today. I didn't pay somebody. It wasn't like a collector that came around and collected my depreciation expense, right? No cash involved. That's the journal entry. And so since it's a non-cash item, we're going to back that out to come up with operating cash flow. We want to know how much cash changed hands this year. And so depreciation expense is a negative. How do we back it out? we add it back, right? So the adjustment we're going to make right here, we're going to add back 330, and I put NC, it means it's non-cash. It's a non-cash item. We're going to simply add it back. So what does that give us over here on the statement of cash flows? 0, right? So that thing didn't affect cash, so we don't want it to show up at all on the statement of cash flows. All right, is there anything else that you see in the income statement that's either non-cash or that's not operating? It doesn't really belong in the O section. It belongs in some other section. What do you see? Gain on sale of property, plant, and equipment. Property, plant, and equipment. What kind of account is that? It's a long-term asset, right? Long-term assets are associated with what kind of activity? Investing activity. So when I sold some equipment, that wasn't an operating activity. That was an investing activity. And so I want to back this one out. So if the gain is a positive number, right, it's a plus, how do I back it out? Subtract. So I'm going to, the adjustment is I'm going to subtract that item. And the reason I'm listing here is because it's not an operating activity, right? We're trying to come up with operating cash flows down here at the bottom. And that's not an operating item at all. Okay, so the first thing I would do would be to back out any non-cash or non-operating items. Then I'm going to go back and reiterate the exercise you just did. All of the rest of these accounts, they potentially, they're income statement accounts, they could potentially be associated with 2 balance sheet accounts because we have accruals and deferrals, right? So let's quickly just talk through it again and think about what 2 accounts would be associated with each one. So sales. If I make a sale on account, then I would have to record it as accounts receivable. That's an accrual, right? It means I'm recording the income statement item before the cash changes hands. So that's one possibility. Is it possible that some of my customers pay me in advance for some work that I do for them? That's a deferral. In other words, they pay me the cash now, I'll do the work next month. Okay, so I'm going to have an unearned revenue account. So the 2 accounts that could possibly go with sales would be accounts receivable or unearned revenue, right? How about cost of goods sold? We already said that there are 2 accounts. What are they? Inventory and accounts payable. Those are the 2 accounts that go with it. General expenses. So is it possible that I pay my expenses in advance? So I record it as prepaid expenses, right? Sometimes I incur the expense and I'm going to pay it later, so I'm going to have some sort of payable account, some kind of short-term payable account, right? So those are the 2 accounts that could go there. Interest. Can I pay the bank early? Pay interest in advance? I could. That's prepaid interest. That would be an asset. Or I might incur some interest and have to pay them later, so I would have interest payable. Either an asset or a liability, right? How about income taxes? Sometimes do I pay my income taxes in advance? And so I would have prepaid income taxes, which is an asset. Sometimes I wait till the end of the year and say, crud, I owe taxes. So I record the expense now and I have to pay it later, so I have income taxes payable. Does that make sense? There's always an asset and a liability that could go with each one of these expense items. All right, so that's kind of the background. What I would like you to do now, going back to the previous page, you've got all the information you need here, right? So you all have this at the top of your page. In words, so what you're going to do is you're going to line up each of the income statement items with these balance sheet account items, right? In your 3-column matrix, you're going to list the adjustments, line them up with the right account they go with. Really quickly, guys, this account tells you in words. You're going to write the increase in accounts receivable, the increase in inventory, the increase in prepaid expenses, the decrease in income tax refund receivable, and the decrease in accounts payable. That's the words you write. What's the direction of the adjustment? Take the absolute value of whatever number's there, and you're going to either subtract it or add it based on what you've got here. Does that make sense, guys? So you're going to use this page. I'll leave it on the screen for you. And you're going to make the adjustments in this column. This is the critical part. This is where the rubber hits the road. Please help your group members. I'm going to give you like 3 minutes to try to take these numbers over here, make these adjustments with these, lining up the words in this column. Ready? Go. Oh, I'm going to leave this up here for you. This is what I would be using to prepare this middle column right here. Alex?
The change aspect in increase statement, where we say increase.
So for example, you're going to say, you're going to subtract the increase in accounts receivable.
Yeah, that's adjustment.
Uh-huh.
So for
Oh, so this column right here, you're going to list the numbers all right off the income statement. So that's the income statement number.
change.
No, this is the income statement numbers. The adjustments column is where you're going to put the change.
Not the change to cash flows. I mean the change to income statement.
You're going to both write what happened, the change, and you're going to put a number either positive or negative. So for example, you're going to do a minus 50, and you're going to put the increase in accounts receivable.
Yeah.
All in that adjustments column.
Okay, all of it.
Yeah. Yes.
On the Tesla, we have like a little more room in the buffer.
Yeah. So that's kind of small. I was trying to fit it on one page. Yeah, we'll give you a little more space.
Wait, so if they're both negative, is the ending one in parentheses?
Yes. So, for example, you got negative 6,000 minus an additional 130. And there's actually another one that goes in here, but then, yeah, you get a more negative number. Yep.
Oh, okay.
Yeah, there's two accounts that go there.
If it's saying like sales is accounts receivable, so accounts receivable would increase by a negative number.
So I would say subtract minus the increase in accounts receivable.
So it would be decreased by 50.
Yeah, if it says minus, I would minus 50. Yeah, I would say I would subtract the increase in accounts receivable. Yep.
Wait,
So you would call this
how
the
do you increase by a negative number?
well, the way you're gonna list it here is it's going to be a subtract, right? So
Yeah.
minus the increase in accounts receivable. That's how I would write that out.
So it would be accounts receivable decreases by 50.
It still increases.
So you're going to subtract the increase in accounts receivable, right? So the words are you're going to describe what happened to the account, but then you either add or subtract based on what you wrote in that third column. All right, work together, guys. You'll get this. All right, guys. This is where it all comes together. This is the part of the statement of cash flows. If you can nail this and get it right every single time, it's such a good feeling. So let me walk you through this. Again, this column here is what we're going to write. We're going to write there was an increase in accounts receivable. There was an increase in inventory. There was an increase in prepaid expenses. There was a decrease in income tax receivable. And there was a decrease in accounts payable. I'm going to write those words, and then I'm going to either add or subtract. So I'm going to subtract that increase in accounts receivable, subtract that increase in inventory, subtract the increase in prepaid expenses, add the decrease in income tax refund receivable. Does that make sense? Okay, so let's look at what this is going to be like. So first thing we did, if you remember, we took care of any non-cash items or non-operating items. We backed them out, right? So that's the first step. We've backed them out, and we get a 0 over on the statement of cash flows. Now we'll start at the top. We'll start with sales. And what balance sheet account did we say we had associated with it? Accounts receivable. Did accounts receivable go up or down? It went up. What was the amount? 50? Okay, so we are going to subtract the increase in accounts receivable. So I would say minus 50 is the increase in accounts receivable. I'm subtracting that. How do I know that? Again, go back over to the previous page, guys. The words say there was an increase in accounts receivable, and I'm going to subtract that increase, right? That's the adjustment. So I'm going to subtract the increase in accounts receivable. Now add across. 10,000 minus 50 equals 99.50, right? That's the cash flow number. Okay, go to cost of goods sold. Cost of goods sold, there were actually two accounts that are going to be made, we're going to make adjustments for, right? So first of all, we had the increase in inventory. What was the amount? 150? 130. We're going to do what? Add or subtract? So we're going to subtract the increase in inventory, and we're going to subtract the decrease in accounts payable. So remember, whatever number you had for the adjustment, you take the absolute value, and you're going to either add or subtract it based on what we had in column 3. All right, so guys, really quickly here, this is a negative number. Are you with me? Cost of goods sold is a negative number, 6,000. So in your calculator, at least in my calculator, you put 6,000, hit the minus sign. So it's a negative number. And then I'm going to subtract 130, and I'm going to subtract 35. So I'm making that negative number become more negative, right? So I'm going to get, over here in the right-hand column, a negative 6165. General expenses. What account was tied to that? Prepaid general expenses, right? And that account went up. And so we're going to subtract the increase in prepaid expenses. So guys, I have a negative 2,000 here, minus another 7. What am I going to get over here in the right-hand column? Negative 2007, right? Now, interest expense, that's an interesting one. Did I have any interest payable? Did I have any prepaid interest? So there's literally no adjustment to make here. There's no adjustment. So we don't have anything here. No adjustment. So we get the same number. Interest expense is the actual interest I paid. Right? If I'd had an interest payable that went up or down, I might have a different number. But since there is no other balance sheet account tied to it, then I assume I must have paid the exact amount, 100. Okay, last one. Income tax expense goes with what? Income tax refund receivable. Did that account go up or down? Went down, right? So we're going to add the decrease in income tax receivable. All right, so guys, hang with me here. I've got a negative number, negative 600 plus 70. What am I going to get? Negative 530 over here, right? So again, if I then take these numbers and add them up, I'm going to get my operating cash flow number. So what have I just done? If I start with net income, and I make all of these adjustments, I'm going to come up with this operating cash flow number, 1148. All right. So guys, once you've done the chart, then it doesn't matter. Just read the problem. If I say do the indirect method, you do the indirect method. If I say do the direct method, you do the direct method. It's going to come straight off of this chart. So let's assume first that I say do the indirect method. What do we start with? Net income. Then what? Plus or minus all these adjustments. And we'll get the operating cash flow number. So the yellow highlighted cells, that would be the indirect method. Start with net income, make all of these adjustments, then you get your operating cash flow number, right? So I'm going to show you both methods because you just read the problem and determine which one to use. So if you're doing the indirect method, we're going to list, so don't write this down, just look. If we're doing the indirect method, you simply say, okay, net income, 1070. Then remember I had these non-cash, non-operating items. I usually list those next. Add back the depreciation expense, subtract out the gain, right? So I did those. And then notice the rest of these. Look at the words here, guys. Increase in accounts receivable. That's the wording I listed right here. Increase in accounts receivable. And I'm going to do what with that number? I'm going to subtract it. I have the increase in inventory. I'm going to subtract that number. Increase in prepaid expenses, subtract that number. Decrease in income taxes payable, I'm going to add that number. And decrease in accounts payable, subtract that number. Net income plus or minus all those adjustments, what do I get? Operating cash flows. This is, again, the indirect method of calculating operating cash flows. What if I told you, no, do the direct method? No big deal. Go back to your chart. You want the direct method? You just simply take the right-hand column. That's the direct method. Now, we got to do one last little thing here. We've listed out these names over here. These are the income statement line items. We're trying to convert those from income statement items to cash flow items, right? So when I sell inventory to my customers and they pay me cash, what do I call that cash? I would call this cash in 9950, I would call it what? Cash received from customers, right? So if it's a positive, it's cash received. If it's a negative, it's cash paid, right? So let's go to the next one down here. Cost of goods sold. What is this cash? Is it a cash inflow or outflow? It's a cash outflow. So it's cash paid for what? Inventory. It's a cash paid for inventory. How about this one right here? General expenses, is it an inflow or outflow? Outflow. So I'm going to call it cash paid for general expenses. The next one here, interest expense. What is this? Inflow or outflow? It's a cash outflow. So it's cash paid for interest. What's this last one down here? Is it cash received or cash paid? Cash paid for income taxes. So the direct method of preparing the operating section, I simply list those out. Cash received from customers, cash paid to suppliers, cash paid for general expenses, cash paid for interest, cash paid for taxes, add them all up, same operating cash flow number. Doesn't matter if I do it the direct method or the indirect method, I get the same operating cash flow number. All right, guys, here's a great exam question for you. How do the direct and indirect methods differ? They only differ in how you calculate the operating section, right? You get the same operating cash flow number. The indirect method, you start with net income, make all the adjustments, and get your operating cash flow number. The direct method, you simply list out directly what are the cash inflows and cash outflows from operating activities. Okay? The investing section and the financing section are the same for both methods. All right. So guys, how do you feel about the operating section? You got to practice the operating section. There's a lot of points on the exam. Remember I said 40% of your exam is a cash flow problem? A lot of those points are in the operating section. Make sure you know how to do that. Okay? You're going to practice all week, and by next Monday you'll just like, oh, this is easy. It'll be easy for you. Okay, so the next section that we're going to work on is the investing section. We've only got about 15 minutes left, so I'm going to go through this with you fairly quickly. So I want to, again, emphasize the importance of using T accounts. So as a quick review for you, I want you to think about the purchase and sale of equipment, right? So all we're going to do to get to the investing section is analyze the equipment and accumulated depreciation accounts. Those are our long-term asset accounts, right? So when we purchased the equipment for $10,000, what was the original journal entry? The purchase was an outflow of cash, right? So what did we do? We increased equipment with a debit, $10,000. We decreased cash, credit, $10,000. That was the outflow when we purchased the equipment, right? Okay, what's happened over time? We've had it for a year or two. We've depreciated it. So what journal entry did we record every year when we recorded depreciation expense? We debit depreciation expense, credit accumulated depreciation, right? So let's just say we've had the asset for 3 years, right? We've been making those journal entries to record depreciation over time. What's that equipment worth to me today after 3 full years of using it? How much did I pay for it originally? I paid $10,000 for it originally, right? But how much have I depreciated over time? $3,000. So what's it worth to me? It's worth $7,000. I call this the book value of the asset, right? It's the original cost minus however much I've depreciated it. That's how much it's worth to me today, $7,000. Right, if I now decide to sell the asset to some other person, how do I determine if I have a gain or a loss? What if I sell it for exactly $7,000? Well, that's what it's worth to me on my books, right? That's equal to my book value, so there's no gain or loss. What if I sell it for $5,000? How much is it worth to me? Worth $7,000. I sold it for $5,000. Is that good news? Yeah, that's bad news. I lost money on it. I lost $2,000, right? What if I sell it for $9,000? Is that good news? Yeah, I made some money on the deal, right? How much did I make? So I'd have a gain of $2,000, right? So let's assume I sell this equipment for $9,000. Okay, so the journal entry to get, if I'm selling this equipment, right? I'm gonna receive cash, so that's gonna be a debit. And how do I get rid of the equipment? So to get rid of this equipment, I need to make a credit. And I have to get rid of the accumulated depreciation. How do I get rid of that? I make a debit, right? That would be getting rid of the equipment to sell it. And then I have to show cash. So here's the journal entry over here. If I were selling that equipment, I would get rid of the equipment, credit $10,000, just like I showed you over there. I would get rid of the accumulated depreciation, debit $3,000, right? How much cash did I sell it for? Sold it for $9,000, so it's increasing cash. Did I make money on the deal? I actually made $2,000, so I'm going to record a gain on sale, $2,000. This would be the journal entry at the time of the sale to show the cash inflow of $9,000. All All right, are you with me? Now, in my operating section, all I want to do is show the cash inflows and outflows associated with the purchase of equipment and the sale of equipment, right? So I would show a journal entry to show the cash paid for any equipment I purchased, and the journal entry to show the cash I received on the sale of any equipment. That's all I'm doing in the investing section. Are you with me? All right, quickly now. I would start the investing section by simply drawing two T accounts. One for my equipment and one for my accumulated depreciation. So look at your balance sheet. What's the beginning balance in equipment? Look at the 2015 balance, 2530, right? What's the ending balance at the end of 2016? 2800. How about accumulated depreciation? Beginning balance? 545. What's the ending balance? 700. So I would start with just simply a T account for each of those, right? What else can we learn by looking at the income statement? Look at the income statement. Did anything else happen to these accounts during the year? Did I record any depreciation expense? So guys, this journal entry right here, did I record any any depreciation expense this year? How much is depreciation expense? How much? 2,000, is that what you said? Okay, so what would that journal entry have looked like? It would look like this. Debit depreciation, it's 330, sorry. Debit, so this was an example I made up. I'm now back to your example, right? On your income statement. Everybody quickly look down for depreciation expense. How much is it? 330, all right. So that journal entry was debit depreciation expense, credit accumulated depreciation, right there. Are you with me? Now, what else? If you read the additional information, what other things happened? During the period, it infers I purchased some equipment. It also tells me I sold some equipment. So really quickly, where's the part about the sale? What does it say? It says, property, plant, and equipment with a book value of 300 was sold during the year, right? So we know we sold some. So guys, what I've done here is I've listed, this is the information we know. This is given from the income statement. We know that we sold some equipment and it had a book value of 300. We don't really even know how much we paid for the equipment or how much it had been depreciated so far, right? So I'm showing you right here, when we get rid of equipment, we credit equipment and we debit accumulated depreciation, right? So what I'm showing you right here, we know that took place, we just don't know the amounts. We know the book value of the equipment was 300, we don't know what the cost was, and we don't know what the accumulated depreciation was. We also know, if you read down below, it said assume that you purchased some equipment for cash, but they don't tell you the amount, so we assume there's some amount Z that we must have purchased, right? So this is a simple algebra problem. Guys, in real life, if you have a company, you would go down and ask your accountant, hey, did we sell any equipment? How much should we receive when we sold it? Did we buy any equipment? If so, how much should we pay, right? So in a real company, you just go ask somebody. But since we don't have that information, we're going to use some algebra to solve for those missing numbers. So we're missing this. X is what? How much that equipment had been depreciated before we sold it. What's Y? That's what we originally paid for that equipment. And what's Z? That's some new equipment that we purchased this year. So what I'd like you to do is take just a minute with your groups. I'd like you to go back and solve first for X. How are you going to solve for X, guys? You started with a beginning balance of 545 plus depreciation expense minus X equals your ending balance of 700. Can you solve for X? Could you do that? Okay, once you solve for X, then you've got to solve for Y, right? You know that Y minus X equals 300. Could you solve for Y? And then once you know Y, beginning balance plus Z minus Y, whatever you solve, equals the ending balance. So take just a minute with your groups, do the algebra to solve for those three missing numbers. Go. Go in order. X, then Y, then Z.
Yeah, because it would be y minus x. It would be y minus
It's 7.2.
So you subtract 3.
Sorry, guys.
First, to figure out y, do we subtract y from x? Or x from y?
Right. So we know the book value is what you paid minus the depreciation, right? So y minus whatever you came up with for x has to equal 300. And that's how you solve for it. Yep.
Thank you. Book value, is it y minus x or y plus x?
Yeah, so what you paid minus what you depreciated. So y minus x equals 300.
Okay.
So once you got x, you can solve for y. Yep.
Okay, thank you.
Can you not use the base, like the base method? You know what that is? So there's like a beginning value and there's an ending value, and you just find out what's in the middle. But like,
Yeah. Well, that's essentially what we're going to do here. Yeah, we'll go through it right now. All right, guys, let's just walk through it together. So this first one, we set it up. We say beginning balance, 545, plus depreciation expense, 330, minus x equals 700, right? If you do that algebra, you solve for x, you get 175. Who got 175? Yes, all right. Now, once we've got 175 in this box here for x, we say y, the original cost, minus x that we've depreciated at 175, equals 300, right? So something minus 175 equals 300. What is the something? 475, right? So if you say book value equals cost minus cumulative depreciation, solve for y, it's 475. Well, now this one's pretty easy to solve for because beginning balance in equipment, 2530, plus z, whatever we purchased, minus 475, that's the equipment we sold, equals ending balance of 2800. Solve for z, and you get 745. So now we have all those three numbers. We can fill them in, right? This is what it looks like. Okay, so guys, we've determined we purchased equipment for 745. Now, the sale down here is a little tricky. We know that the book value of the equipment sold was 300. In other words, it was worth $300 to us. We went out and sold it to somebody else, and we had a gain on it, right? So that means we sold it for equal to 300 or more than 300. We sold it for more than 300, right? How much did we sell it for? Z, some number z, minus 300 equals 100. Take 30 seconds and come up with the number together. Okay, it's got to be how much? It's got to be 400. Guys, the two red numbers. We had to know how much cash we paid when we purchased equipment and how much cash we received when we sold equipment, right? Those are the two numbers we need to know for the investing section. So really quickly, guys, the journal entry, when we purchased equipment, what did it look like? Equipment went up with a debit and cash did what? Cash went down with a credit. That would be the journal entry to purchase this equipment. So cash went down, right? What about this sale of equipment? How much cash did we receive? 400, right? What was the journal entry? Well, we had to take the equipment out that we sold, credit equipment, and we had to take the accumulated depreciation out, 175. So the journal entry would look like this. Decrease accumulated depreciation, decrease equipment, cash came in, how much? 400. And how much was the gain? We had a gain on the sale of 100. The journal entry has to balance, right? The debits have to equal the credits. That's the journal entry. So, guys, the investing section simply has to show the cash inflow and the cash outflow. So my investing section would simply be cash received from the sale of equipment, 400, cash paid for the purchase of equipment, 745, net cash flow from investing activities, outflow, net 345. Easy, right? Okay, last section. We want to do the financing section. So if you look on the balance sheet, it's going to be long-term debt, common stock, and retained earnings will be affected by it as well. So what I would do is simply draw a T account for each of those 3 accounts. Oh, by the way, they tell us dividends paid is $448, right? So here's what I would do. Long-term debt had the beginning balance of $14.95, had an ending balance of $11.15. Why would long-term debt go down? I must have paid the bank, right? I must have paid them back part of the principal. So I'm going to have a repayment of principal. It's going to decrease long-term debt. Common stock did what? Had a beginning balance of $800. It went up to $975. Why would common stock go up? We sold some more shares, right, to the shareholders, and they gave us cash. It's going to be an increase in cash. So this will be an increase because of new stock that we issued. And finally, guys, retained earnings. This is a tricky one. Retained earnings. We started with a beginning balance, $998. We know from the income statement that we earned income of $1070. And they told us we paid dividends of $448, and we have an ending balance of $620. Guys, this exactly adds up. I could have left it out and said, how much were your dividends? And you could have solved for it, right? Notice that there's an account missing. Do you see dividends payable anywhere on the balance sheet? If there had been a dividends payable, it's possible that the dividends declared might have been different from the dividends paid. In this particular example, they're the same. For the practice exam, watch for this. There's going to be a dividends payable account. So I'm just warning you. It's like the one we did in class last time. Okay, guys, we've only got a few seconds here, but quickly get your calculators out. 1495 minus X equals 1,115. How much was the cash repayment for debt? $380, is that what you get? Okay. Common stock went up by exactly how much? 175, right? So guys, here's my my financing section. Cash paid for the repayment of long-term debt, outflow 380. Cash paid for dividends, 448. Cash received from the issuance of stock. Stick with me, guys. Please hang with me. There's my net financing activities, cash flow from financing activities. So if I put all 3 pieces together, I'm just going to show you, assuming that they asked for the indirect method. So the investing section, the operating section, I'm showing the indirect method. Net cash inflow, 11. Guys, please don't put stuff away. Shh. We want to be calm for just a minute. So cash inflow from operating activities, 1148. Investing activities, net outflow, 345. Cash flows from financing activities, net outflow, 653. If I add these 3 sections up, positive operating cash flows minus investing activities outflow and minus financing activities outflow gives me a net change in cash of 150, which was the answer from the beginning. Cash went up by 150. We explained it. But guys, the problem's not over. If you stop right here, you're not done. You have to take the change in cash, add it to your beginning balance to get your ending balance. This is like 4 or 5 points on the exam just for, this is given, right? Even if you didn't even do the whole statement of cash flows, would you know the change in cash? Would you know the beginning balance and the ending balance? So you got to make sure you do these. All right, hang with me for one more minute. Guys, this is what you have to be able to do really, really well, hopefully by next Monday, but at least get good at it by Thursday. I'm just going to quickly show you 2 things. There were 2 problems, and I'm just going to post the answers here, but I tried to go through, this is an example, just to show you how to do it. Step 1, calculate the changes. Step 2, determine the section. Step 3, use the rule of thumb to determine if it's increase or decrease. This is just an example. You had problem 2A, you're given income statement and 2 years of balance sheets. So I'll show you how I went through the exact same steps and did the little chart to come up with the answer. I'll just post this for you. Then we had the final problem, which was 2A. Same thing, you're given an income statement, 2 years of balance sheet. So I did the same thing. I calculated the change, I figured out the section, I calculated the direction of the change. I'm telling you guys, trust me on the process that we learned today. It works every single time, and your job is to figure out, to practice and practice so you feel confident doing the statement of cash flows. All right. So I'll just make one last point. The FASB prefers the direct method for the operating section, but they said you can choose either one. So most companies choose the indirect method, but they have this funny rule. If you choose the direct method, you have to provide a reconciliation using the indirect method. So if you choose direct, you basically have to do both ways. So you notice they have direct method operating section. They also have to provide a reconciliation or the indirect method as well. So what do most companies choose? To do both ways or just one? Most companies choose just to do the indirect. All right. Thanks, guys. We'll see you all on Thursday.